What is amazing is how fast the time will go. I know you've heard it. Your parents probably said it to you, but I'm saying it as well. It's going to go by quickly. So we have to talk about this issue. The money, when you have your first job, there's going to be lots of demands on it because you probably have some debt outstanding. You'll get credit card offers like nobody's business. You'll have to get a car. But I want to talk to you about, well, there's only 4 ways to wealth. And we're going to talk about retirement not in the sense of, gee, a point in life where I can just relax and not do anything. I don't even like the word retirement because it basically means to be put up on the shelf, to be taken out of circulation. I kind of like the word financial independence. Isn't that a better word, better set of words? Because then you work if you want to, not because you have to, and it's kind of fun to be at that point. I'm here because I want to be, not because I have to be, so it's pretty neat. But so this issue of getting started and listening to the discussions about credit and all that and how people spend money on things that are depreciating assets, they wish they wouldn't have done it, and they put it on credit. So let me pass this on to you. You can't build wealth by buying things you don't need with money you don't have to impress people you don't like. So when you've got that first job and you've got something you've never had before, which is a pretty good income, but you've got some demands, I really want to encourage you to start as quickly as possible, because the time will go by, and the earlier you start saving, the better off you'll be. So let's talk about that a little bit. We'll talk about different places you can put it, but now there's only 4 ways to wealth. And if you come up with one other, please let me know. I'll be glad to add it to my talk. You can marry it. Not a good idea. I heard a female friend of mine say to another female friend, a man is not a plan. And I kind of like that. That was pretty good. You can marry it. You can inherit it. Probably not a wise choice. You can hit a windfall, or you can, what's the last one? Accumulate it. You can earn it and accumulate it. Now, think about what your first job may earn you. Now, I'm not sure, heck, my first job earned me $8,000 a year. Whew. All right, so let's say you're going to make $50,000, $40,000, I have no idea, but just pick a number and multiply it by the number of years you'll be working. Surprise, you're all millionaires. You're all multimillionaires. You're just on the installment plan. And it's so important to understand that because when you are first in your career, you have a lot of something and very little of something else. You have a lot of what's called human capital. And human capital is your talents, your abilities, your earning power times the number of years you'll be working. You have a lot of human capital. And what most you have very little of is investment capital. So the whole idea here is as life progresses, human capital number actually goes down because you've got a lot of years behind you, fewer years in front of you. Human capital goes down, and you have to replace it with something, so your investment capital has to go up. So the earlier you start, the better. I was trying to think about this whole issue of compound interest. You know, Albert Einstein said it's the 8th wonder of the world. And we were talking about whether I should be sharing some specific numbers with you. And I decided, as I was thinking about, yes, I can throw out a bunch of numbers, how to get to $1 million, how to get to your first million, your second million, and so forth. I decided, I said, what is a good visual for compounding? And I saw one on the internet. Actually, it went along with Albert Einstein's quote. And I think it might be a good way to think about it. And it's a snowball that you roll up. So you get that little snowball and you start rolling it, and you roll it and roll it and roll it. It's starting to get a little bit bigger, but it takes a long time. And all of a sudden, it's starting to get heavy, and it's getting big. Now we've actually got something like the bottom of a snowman. But how long did it take you to get that big? But now that it gets that big, especially you start rolling it down a hill, and it starts gathering on itself, and pretty soon it's as big as a car. So as you're investing, and many of you I know are familiar with the numbers, some of you might not be, and you might want to go find a calculator and just plug in some numbers, and you'll feel this way, and that is when you first start saving, it's like, I'm not getting anywhere. I've been at this for months. My balance is just tiny. I've been at it for years. It's not that big, but what happens is it takes off exponentially a little bit later in life. So the first decade, it might feel like, man, look, I've only got $40,000, $50,000 saved. And then all of a sudden, it's 100, and then it's 200, and then it's $500,000, and it goes exponential on you late in life. But the trick is you've got to get started early. A lot of people, of course, I've done a lot of consulting over the years, and a lot of people who wait too long. There's always excuses. Procrastination's my greatest fault. It causes me such sorrow. I really should stop doing it. Perhaps I'll start tomorrow. So, okay, I got college debt. I got to buy a car. I'm getting married. Got to buy a house. Going to have kids. College cost. How old are you? How old are you now? All of a sudden you're in your 40s and 50s, and I can't tell you how many people I've talked to who, I shouldn't say waited too long, but now it's really, really difficult. So then their financial options are limited, got to work longer. Here's one of the secrets of being able to retire comfortably, and that's to be able to retire early. Get started early enough, it gives you a lot more choice. So let's say you've got your first job. Let's talk about where we can put the money. So you got your first job, pretty good income. Of course, you want to have your emergency fund, you want to have your savings account. Now, money can go in 3 places. I want to really emphasize this because it's interesting how people misconstrue things. People will ask me, what are your IRAs paying? IRAs don't pay anything, they're a box. You can put stuff into the box, and then I can tell you how it's paying. So you can put money into 3 different boxes. One is a taxable box. It's a regular investment account or a savings account. You have to get a thing called a 1099. You have to report it on your taxes, just regular stuff. The second box is one we're going to talk about quite a bit, and it's a tax-deferred box. Things like 401ks and 403bs, I'll explain that in a second. And then there's another box over here we're going to call tax-free. So all of the money you invest will either go in a taxable box, a tax-deferred box, or a tax-free box. Now, we haven't talked yet about what types of things you can invest in, but let's just talk about this middle one, because it's kind of the one that's a little bit complex. Now, everybody says things like, what is this 401k? I've read about it, but what is it? Okay, just to clarify things, it's just the Internal Revenue Code. The Internal Revenue Code dealing with saving for retirement is Section 400. So there's 401s, 403s, and 408s. More commonly known as a 401k, that's a subsection. 403bs are tax-sheltered annuities for teachers, and 408s are IRAs. So you're going to have lots of choices, and it's going to be very confusing, but here's some things I would suggest. When it comes to a 401k, if your employer offers a match, don't leave free money on the table. Really frustrates me when I find out that somebody can participate in a 401k and chooses not to and has an employer match. Very typical match is 100% of the first 3 or 4% of pay. So if you put in 4%, your employer puts in 4%. What kind of rate of return is that, by the way? 100%. Who said that? All right, I got a gift for you, because you'll be a millionaire the first. Who said 100% first? Come on down here. Just come on down here. Because I want you to get something that you can tell everybody what I just gave you. What did I just give you?
A $1 million bill.
A $1 million bill. Congratulations. He'll probably be the first one to get there. Now, my only suggestion is hang on to that $1 million bill, and when you get to your first million, pass that on to somebody else and say, how I got there was, I didn't marry it, I didn't inherit it, I accumulated it, and here's how I did it. All right, so it's 100% return, right? You put in 4, the employer puts in 4. Now, I would suggest you go above that if at all possible. If you start early enough, saving 10, 15% of your income, you'll probably be fine in retirement. Most people don't, they wait too long, and that's what gets them behind. So if you went, let's say, 8%, and the employer puts in their 4%, you're already up to 12. It's not all your money, though. Some of it's the employer's money. But I would highly encourage you to at least go to the match. Now, above that, then it gets a little tricky, because then if you're putting in and you're not getting a match, but it's still deductible, but here's an issue, and that is when you have your first job, how much is the deduction worth to you now versus a little bit later when your income goes up? The higher your income, the higher your taxes, the more valuable the deduction. So one thing I encourage all young people to do, all of my kids when they had their first job, I had them open a Roth IRA instead. Of course, I helped them fund it. Now, there's a regular IRA, individual retirement account, but there's this thing called a Roth IRA. Here's how you get yourself immortalized. Senator Roth of Delaware got this passed, got his name stuck to it. He's now deceased, but he's now immortalized. And all a Roth IRA is, and most all of you will be eligible as long as you have earned income. Even singles, I think you have to be up to about $116,000 before you're ineligible for it. The money you don't get a deduction for, but it grows tax-free, that's over in this bucket, not tax-deferred. One of the problems with tax deferral is later in life when you take it out, what do you have to do? Still have to pay taxes. When the one grows tax-free, you take it out and Uncle Sam doesn't get any of it. So while you're young and the deduction doesn't mean that much, I encourage all young people to get a Roth IRA going. All of my kids have one, because there's another reason. You can get to your principal again. So you put $20,000 in, you can get to the $20,000, no restrictions. And you can take $10,000 of earnings out tax-free for the purchase of a primary residence. That also gives you some more options, because in the employer's plan, the 401k, they've got rules as to what you can and can't do. With the Roth, you own it, and you have a lot more flexibility. So we always try to encourage people to have several different types of accounts. Don't have time tonight to even talk about these 3 boxes, what types of stuff you can put in them: stocks, bonds, mutual funds, all sorts of things. Maybe that'll be for another evening. But I just encourage you to get started. Financial planners are certainly worth any fee, well, any reasonable fee that you'd pay them, because they'll help you get on track and stay on track. So I was trying to think of what could I close with that would be very helpful for people in where I was not that many years ago. And gosh, all sorts of things ran through my head. And then I had come across a little booklet. It's very short. A gentleman by the name of George Samuel Clayson had written a series of pamphlets back in the 1920s. It's only 144 pages, so you may want to pick this up. It's called The Richest Man in Babylon. And I've updated the language a little bit, but I thought for a really short book, it had a lot of great lessons. And these are the 8 points. They're timeless lessons in financial independence. And here they are. Pay yourself first. Sound familiar? Live within your means. Learn how to invest. Protect yourself from loss. Invest in your home. It may be your biggest expense. Have a retirement plan. Invest in yourself. Monitor your goals and your wealth. So enjoy the journey. And again, time is going to go by really fast. I've noticed now that I'm in my 60s that time travels at the speed of your age. So yours is going along at 20 miles an hour, mine's going along at 60 miles an hour. So please be careful not to procrastinate. Have a great time on this journey. Good luck to you all.